These 5 charts show the top 5 main news and events of today. A war in the Middle East just cracked the $100 oil ceiling, and the entire market exhaled at once. Bitcoin is hitting a 6-week high. NVIDIA's CEO just said $1 trillion on stage. And Meta announced 16,000 layoffs, and investors cheered. If any of that sounds backwards to you, stay with me, because today's session is one of those rare days where 5 separate stories are actually one story, and this video breaks all of it down. Welcome to the channel, where we break down investing using clear, data-driven charts to track where institutional money is moving and what that means for your portfolio. We publish a video of the main market events every day. Subscribe so you never miss one. Let's start with the event that set the tone for everything else today. Look at the orange line on this chart. That is WTI crude oil, measured in dollars per barrel on the left axis. The blue line is the S&P 500 on the right. The date range runs from February 27th through today, March 16th. Here is what happened. On February 28th, that dotted vertical line on the left, the United States and Israel launched strikes on Iran. Oil immediately gapped from $64 to $71 in a single session. Then it kept climbing, $78, $90, $95, and by March 13th, it had touched $99 a barrel, just below that psychologically brutal $100 threshold. Now look at what the S&P 500 did during that same stretch. It fell steadily from 6,900 all the way down to 6,632, a 2026 low, as investors priced in stagflation, supply disruption, and a Fed that couldn't cut into a supply shock. Then, this weekend, something changed. Several commercial tankers successfully transited the Strait of Hormuz for the first time since the strikes began. The market read that as a signal, not peace, but not total blockade either. Oil dropped nearly 5% today to $93.50, and the S&P snapped its 3-week losing streak, closing up 1% at 6,699. The 2 lines on this chart move in almost perfect opposition. That is not a coincidence. Oil above $100 was the single biggest weight on this market. Today, for the first time in 2 weeks, that weight got lighter. Keep that in mind, because the same pressure that was crushing equity multiples was also holding back one sector in particular, and that sector just got its biggest catalyst of the year. 3 bars. That is all this chart needs. The left axis shows annual revenue in billions of dollars. The x-axis marks 3 fiscal years, 2024, 2025, and 2026. Fiscal year 2024, $60.9 billion. Fiscal year 2025, $115.2 billion, an 89% jump year over year. Fiscal year 2026, $215.9 billion, another 87% year over year. The third bar is green because it's not just a record, it's a structural step change. A company crossing $200 billion in annual revenue while still growing at nearly 80% per year is not normal. It has almost never happened at this scale. But the number that matters most today is not on these bars. It's the annotation in the upper right corner. At this morning's GTC keynote, Jensen Huang walked on stage at the SAP Center and said at least $1 trillion in combined orders for Blackwell and Vera Rubin chips through 2027. Last year at GTC, he said $500 billion. He just doubled it. NVIDIA stock moved up 2% today to an intraday high of $184. That's a measured reaction, not euphoria, and that actually tells you something important. The market is treating this as not a surprise, it is as confirmation. If you want this level of institutional data analysis, the flows, the forecasts, the structural signals delivered every single day, this channel is exactly where to find it. Make sure you are subscribed. The AI build-out is not slowing, it's doubling, and the companies spending that $1 trillion are the ones in our next chart. Why Wall Street cheered 16,000 pink slips. This chart splits into two panels. On the left, Meta's layoff history, bars in orange and red showing headcount reductions going back to November 2022. On the right, Meta's capital expenditure, in blue, year by year from 2022 through the 2026 guidance range. Read both panels together and the logic becomes unavoidable. Every time Meta cuts people, it redirects that capital into infrastructure. 2022, 11,000 jobs cut, $31 billion in Capex. 2023, another 10,000 gone, Capex dipped to $27 billion as the efficiency year ran. Then the AI pivot accelerated. 2024, $37 billion. 2025, $72 billion, a 94% jump in a single year. And the 2026 guidance, $115 to $135 billion, with a midpoint of $125 billion. Now look at that March 26 red bar on the left. 16,000 jobs, roughly 20% of the entire workforce. That is the largest single layoff event in Meta's history. Reuters confirmed it on March 13th, and Meta's stock closed today at $627, up 2.2% from the prior close of $613. Why does the market cheer? Because it's seen this movie before. In 2023, after the first two rounds of cuts, Meta stock returned 194% for the year. The market is not rewarding cruelty, it's rewarding capital efficiency. Every dollar not spent on headcount is being redeployed into servers, data centers, and chips, most of which flowed directly to the company in our previous chart. If you want to go deeper on AI capital flows, crypto, and building long-term wealth, our social accounts break these stories down between videos. Find us and follow along. The tension here is real. Tens of thousands of people losing jobs is not a clean story, but the data is unambiguous, and understanding it is how you stay ahead of where institutional money is moving. Speaking of which, that same institutional money has been quietly making a very different kind of move in crypto. Left axis measures weekly net ETF flow in dollars. The orange line, tracking across the top, is Bitcoin's spot price. The bars are green for inflows and red for outflows. Start on the left. The week of January 2nd, $1.16 billion in net inflows. Strong start to the year. Then the red begins. 5 consecutive weeks of outflows, marked by that shaded band in the middle of the chart. The peak exit, negative $1.22 billion in a single session at the end of January. Total drain across the 5-week streak, $3.8 billion out of U.S. spot Bitcoin ETFs. Watch what happens to the orange BTC price line during that stretch. It tracks the outflows almost exactly, falling from 84,000 down to 64,800 by late February. Then something shifts. The week of March 6th, $767 million in net inflows. March 13th, another $530 million. Total March inflows now stand at $1.3 billion. And today, Bitcoin is trading at a 6-week high of $74,512. Here's the number that should make you stop and think. BlackRock's IBIT alone is capturing 78% of all March inflows. This is not retail FOMO driving this recovery. This is institutional reallocation, large balance sheets rotating back in after a 5-week exit. That changes the character of the move entirely. The same geopolitical easing that broke the oil ceiling today also removed one of the biggest macro headwinds for risk assets, and institutions didn't wait for confirmation. They were already moving back in last week. But if Bitcoin's move today is impressive, what Ethereum did is something else. 3 lines, all indexed to 100 at February 13th. Orange is Bitcoin, light blue is the S&P 500, purple blue is Ethereum. Look at February 27th. Ethereum drops to 87.5 on this index, meaning it had lost nearly 13% of its value in 2 weeks, while Bitcoin had only given back a few points. Ethereum looked like the weakest of the 3.
Now trace that Ethereum line from February 27th to today. It climbs back through 100 by March 13th, and today, March 16th, it closes at 106.9, meaning it has fully recovered and is now in positive territory for this 30-day window. Bitcoin sits at 110.1, impressive. The S&P 500 is at 98, still slightly below the baseline. But look at today's specifically. Ethereum gained 6.9% in a single session. Bitcoin gained far less. The S&P gained 1%. Three catalysts drove this today. Bitmine announced the purchase of 60,999 Ethereum, $138 million in the past week alone, becoming a corporate Ethereum treasury in the model of MicroStrategy. BlackRock launched its ETH-B staking ETF, which has already drawn over $45 million in its first 2 trading days. And the ETH to BTC ratio, which had been sitting near a multi-year low, is now ticking higher. One more thing. The FOMC meets Wednesday. If the Fed holds rates and signals dovish language, the assets most sensitive to rate expectations outperform.
Historically, that means ETH moves faster than BTC in both directions. The question this chart is asking, and not yet answering, is whether this is a single-day spike or the beginning of a sustained rotation into Ethereum. Wednesday will tell us a lot. This is not financial advice. Everything here is data-driven market analysis, and you should always do your own research before making any investment decisions. Today's dominant theme can be stated in one sentence. One geopolitical data point, tankers moving through the Strait of Hormuz, unlocked a cascading risk-on trade across oil, equities, AI stocks, Bitcoin, and Ethereum simultaneously. 5 separate charts, one underlying force, and the market moved all of them together. The open loop from chart 1 closes here. It was never really about 5 stories today. It was about what happens when the single biggest macro weight on global risk appetite gets just slightly lighter. Oil gives way, multiples expand, institutions re-enter. And the fastest-moving assets in the world, crypto, lead the charge before anyone has time to react. The question that lingers, if oil holds below $100 and the Fed goes dovish Wednesday, what does this rally look like by the end of the week? If you found this content valuable, subscribe and hit the like button. Thank you for watching, and see you tomorrow.